Hello, and welcome back to the Money Bear podcast. This is your host, Chloe Daniels, better known as Clo Bare Money Coach on the internet. And we are doing our quick tip. We're going to talk about permanent life insurance. What are the pros and the cons? Because I feel like when I covered this in the past, I did it on a quick tip episode, I'm pretty sure, probably about a year ago. And I remember it being very ranty. So I'm like, I want to do another episode where I'm really breaking down the different types of permanent life insurance policies so that you can get a better understanding of what these policies are and start to recognize them when you are potentially confronted by a salesperson who is trying to convince you that your 401k is a scam or your Roth IRA is a scam and you should be using these products instead. It's something that comes up all the time. And I get really heated about the topic just because I get frustrated when people are misleading folks away from things that are actually helpful to them to try and sell them something with the goal of them making a huge commission off of it, even if that's not actually what's best for the person they are selling it to. So because of that, I actually made a PowerPoint presentation because I want to stay on topic because I am so good at ranting about this stuff. So if you are one of our few YouTube subscribers, you will get the pleasure of viewing today's episode whenever the YouTube version comes out as a PowerPoint presentation as well. So, and if you're in the Lazy Investors course, I'll be popping this video into the Lazy Investors course immediately after this. So you will have access to those slides there. So we're doing it different today because I feel very passionately about this. And I was like, you know what? I'm just going to put together a slide deck so I stay on task. So we'll get to that here in a few minutes. But first, a little life update. Again, if you're watching the YouTube video, you'll probably notice there's a bunch of white stuff on my arms because I have calamine lotion everywhere because your girl has broken out with a very mysterious rash. It looks like chicken pox, but I'm pretty certain it's not chicken pox because I had chicken pox as a kid. And if it was chicken pox, I'm pretty sure it would be spread like all over my body. And it's pretty isolated to my arms and my legs right now, knock on wood, and specifically just in this like one elbow area. So I've already got a steroid cream that I'm using to kind of manage it, but I'm like, I feel like I can't catch a break. I mean, you guys remember when I first moved to San Diego, I got that nasty poison ivy / poison oak rash where it was like oozing. I apologize if you are not into this kind of content. Just skip ahead 10 minutes. It was nasty. I had to like wear a wrap. I had to take a break from physical activity for like over a week, which whenever I have to take a break from like doing physical activity, whether it's the gym or jujitsu now, that is a big bummer for me because physical activity really helps me maintain peace. It helps me maintain like my feelings of being okay. And when I can't do the things that I love to do because of something like a rash, yeah, it takes a toll on my mental health. So that's my life update there. The good news, speaking of mental health, is that I now have insurance that covers mental health, and I now have an appointment with a therapist on Monday, which I'm really excited about, and I'm sure I will tell you guys about it as I continue. The bad news is that all of the therapists that I wanted to see or had interest in seeing do not accept insurance or are billed as out of network, and that's not really a criticism of therapists. I understand there's probably some very good reasons as to why they don't want to be under insurance, and in fact, they may even be more affordable by not going into insurance, but it is frustrating to just be like the medical system finally is allowing us to cover mental health, and for me anyway, and now all the therapy is out of network. The good news, again, flip side, is that at least what I'm spending on therapy will go towards a deductible. But granted, my deductible is like almost 10 grand a year. So the likelihood, knock on wood, that I will reach my deductible in the next 6 months is probably zero, unless something catastrophic happens, which obviously we're knocking on wood that nothing like that happens. So yeah, I'm really excited to go back to therapy. I feel like there's a lot of things I can be working on right now. And it's funny because like I'm probably the happiest I've been in a really long time. I am living my life. I'm really happy to be in California. I'm so grateful. Like every day when I'm going on my walks with Logan and when I'm hanging out with Cash, I'm just like, so grateful that this is my life. And there's a lot of gratitude going on in my heart right now. So that's been a big game changer. But at the same time, I still struggle with things like having a temper, blowing things a little bit out of proportion, not to other people, but like internally, where I just get like really mad about something and it ruins my day or it ruins my hour. And I don't really want that. I don't want to deal with that anymore. I want to like find ways to not get so hot-headed. And then on the flip side of things too, I just want to make sure I'm doing what I can to stay open to love and to stay open romantically. I know right now I have realized I'm most definitely not over the relationship that just ended with Tarek. He and I just like, I really thought he's my forever person. And to have that just end kind of suddenly doesn't feel good. And there was a lot of questions I still had. And luckily, he and I have been able to talk through some of it. And I got a little bit of closure, I think. And either way, I've just realized I'm not fully over it. So I'm not going to be dating right now, but I do want help in navigating and being open to love in the future, but also not repeating the same patterns. I feel like I have had a lot of patterns, which you guys have probably heard through me diving deep into my story. There is a lot of patterns of, going after people who are not necessarily right for me. I will say Tarek was like the first relationship that I've had that wasn't toxic, at least in the last like 10 years. So yeah, we're making progress. We're heading in the right direction, but there's still a little bit left to go, I feel like. And I feel like I need guidance in order to understand exactly what I need to do to stop repeating these patterns. So yeah, and I found out he's also in therapy, which I think is amazing. And I'm really proud of him too. So yeah, we've opened the door to communication again, which has been healing in its own way. And yeah, we'll just kind of see what happens. So I'm generally doing good other than these rashes that are preventing me from going to jujitsu. I'm hoping they clear up pretty soon. They seem to be clearing up pretty quickly, but they're nasty. This is honestly a grosser rash than what I had when I had that poison ivy rash, because it like almost makes my skin brittle. And so if I rub or scratch it, it like just scratches off a period of my skin, which is not pleasant. It's pretty gross. It's pretty gross, I gotta say. So hopefully, I'm really hoping I don't scar from it. Granted, it's on my arm, so it's not the end of the world, but I'm just like, what is happening with me? Am I just allergic to California? So yeah, I had that poison ivy rash. Then I had the not knee break, but my knee popped at jujitsu. And now I have this like chicken pox thing. And then before that, I found out that I'm allergic to crab and my eye swole up. So I just feel like it's like one little annoying thing after the other, but maybe it's just a test to make sure I do really want to be here. So if I'm sitting weird, it's because it's comfortable for me to sit like this because of my rashes. I feel so gross. I'm such a gross lady. So anyway, let's get to talking about today's topic, which is permanent life insurance. And I titled it The Pros and Cons of Permanent Life Insurance, which is a little tongue in cheek because if you know me, you know I am really not a fan of these products. And more that I'm not a fan of these products, I'm really not a fan of how these often get sold to people, because I do think that life insurance salesmen can be very deceptive. They will often call themselves financial advisors, but the term financial advisor is not a regulated term. So pretty much anyone can call themselves a financial advisor. And unfortunately, an insurance salesman likely does not have the kind of training that a true financial professional has. Like if we're talking about a certified financial planner, they're going to have a holistic view of all the different options when it comes to retirement and building wealth. Whereas somebody who is just certified and has their series to be able to sell life insurance products is not going to have a fully holistic view unless they decide to go out and get it. And likely they don't have a lot of incentives to do that. So let's talk about the pros and cons of permanent life insurance. But first, I want to talk about like what is permanent life insurance. So permanent life insurance provides lifelong coverage for your life insurance. So it's a lifelong policy. Whereas normally when we're doing life insurance, we're thinking of it as term insurance. So for a set period of time, maybe for 20 or 30 years, while you have dependents, you have life insurance so that if you were to pass prematurely, your dependents would then have the benefit of your life insurance policy, whether that's a $500,000 policy, $1 million policy, or more. Term insurance is fine. Term insurance is what most people are probably going to benefit from. But unfortunately, term life insurance gets confused for these permanent life insurance policies. So term, this isn't about you. We like term. If you have dependents, if somebody's relying on your income, term life insurance policy, at least 90% of the time, if not more than 90% of the time, is probably the way to go, especially because term life insurance is very inexpensive when you are young. And like, if you have it for that 30 years, you buy it when you're 20, you know, maybe it's going to be $20 to $30 a month for that period for the term in which you have it. Now, permanent life insurance, one of the key things that salesmen really like to use to sell it is that they often have a savings component, which is called the cash value that we'll talk about here in shortly. But these policies, because they are permanent policies, meaning they're supposed to last your whole life, they are definitely more expensive than term policies. You know, if we're talking about $20 a month for term policies, we're talking like $200 plus a month for a permanent policy. And I have seen people who are paying $1,600 a month for permanent life insurance policies that were not actually beneficial to them at all. So keep in mind as we go into this, like this is a quick tip, so we're not going to dive super deep into it, but I want you to have at least the education you need to make better decisions and understand when somebody's trying to sell you one of these products. But these policies are very complex. And often the people who are selling the policies to you don't even fully understand the policies themselves because they're meant to be confusing. We will cover the basics here, but every policy is going to be a little bit different. So I said we were going to talk about the cash value. The cash value is what these insurance salesmen get very excited about and enjoy selling to you, is because it's this idea that you're combining a life insurance policy almost with a savings account. So these cash value components, think of them like a savings account, is essentially the savings account that a portion of what you pay into the policy goes towards. The cool thing about the cash value is that the money that ends up in the cash value product, you can either use it to pay your premiums or you can withdraw it completely tax-free, and you can also borrow against it completely tax-free. Now, there are several different types of permanent life insurance policies. We're going to cover the basics, the ones that are most popular, but almost all of them, in fact, I think every single one of them is going to have that cash value component. I've never seen a permanent life insurance policy that doesn't have a cash value. Now, how the cash value works is that you pay your premium and the cost of the insurance and other fees are taken out of your premium, and then whatever is left over is added to your cash value. Now, usually in the first 5 to 10 years of you having the policy, almost all of that premium is going towards fees and the cost of the insurance. So likely you're not actually putting a lot into that cash value. It takes a long time for that cash value to build up, unless, of course, you decided to put extra money in for that cash value. And again, it depends on the policy. Cash values, like I said, they also serve as a reserve. So if you have a varying premium, which we'll talk about a few different types of these life insurance policies that do have varying premiums, if what you're paying into it is not enough to actually cover the premium in full, they'll use that cash value to pay for your premiums. They'll just take it out of that cash value. Now, let's talk about some of the most common different types of permanent life insurance. So whole life insurance is a policy where you, of course, have insurance for your whole life, but the premium, the amount in which you're paying every single month, it stays the same. It's a fixed premium and the cash value slowly accumulates. Now, insurers are going to likely have different payment options for your whole life insurance policy or any of your permanent life insurance policies, where you could pay your premium for a set period of time, like until you're 100, or for a set period of time that's maybe only 20 years or 30 years or 40 years, while you'll maintain that coverage even after you stop your payments. So for example, if you were doing that where you're like paying only for 10 or 20 years and you want to have that whole life insurance policy for your whole life, likely your payments in those 10, 20, 30 years are going to be significantly higher, so that it'll have enough in the cash value to essentially cover your premium payments for the rest of your life. But there are also single payment policies where you can just buy a policy in full, and then you will have a set amount of life insurance for your whole life. Now, when you die, just like term life insurance policy, the beneficiaries will receive the amount of the policy. So they're going to like, let's say you buy a whole life insurance policy for $1 million. When you die, that $1 million, which is the premium or the policy amount, the death benefit, that is what your beneficiaries are going to receive. They are not going to receive whatever's in that cash value. So that whole life, that cash value is essentially you use it or lose it when we're talking about a whole life insurance policy. Again, with that cash value, you can take out at any time, you can borrow against it. But if for some reason, and this is kind of like unfair, I would say, is that if you don't pay back that cash value, it will reduce the death benefit. And the reason that I think that's unfair is because you're not passing on that death benefit, that cash value. So, or I just said that your beneficiaries will receive the amount of the policy. So if it's $1 million policy, they'll receive that, but they won't receive that cash value. So if you have money, that cash value, it's not going to get passed on. That's going to get absorbed by the insurance company. But again, if you take that cash value out, you borrow against it, it's actually going to reduce the death benefit. So it feels like unfair, right? So another type of permanent life insurance policy is universal life insurance and indexed universal life insurance. With universal life, you can actually adjust your premiums at any time and your death benefit as you go. So that gives you flexibility as your financial circumstances change. Now, that means the payout, your beneficiary payout, will also change as you change your premiums. But unlike the whole life insurance policy, the payout to the beneficiary can also include that cash value. Now, indexed universal life insurance is a little bit different. So it's the same in that you could change your premiums at any time. It can be flexible, but the money that you put into the cash value, you can decide to put it into kind of like a bucket, a sub account that is tied to a stock or bond index. It's usually the S&P 500. But the idea behind it is that cash value will grow at a rate that is linked to the S&P 500. However, if you just get regular universal life and not indexed universal life, you're going to get a set interest rate over that period of time. Now, indexed universal life insurance is very complicated. You'll also hear it as IULs very often. And I think about 12% of life insurance policies are like indexed universal life insurance policies. They come with a lot of ups and downs than other policies for life insurance. So like I said, the cash value in an indexed universal life policy is going to get put into a sub account that mirrors a stock market index. However, you will have caps and you will have minimums. So you will not make the full amount of what the index is doing. So if the index, the S&P 500, let's say it goes up 30%, you are not going to make 30% on that cash value that's inside of it. So remember, that cash value is going to be whatever's left over from your premium. So it's already a small amount anyway. But if your cap is, let's say 12%, even if the S&P 500 returns 50% in a year, your maximum that you will receive inside of that index universal life cash value is going to be maybe 12%, whatever the cap is. The insurance company will cap you at what you can earn because they got to make money. But what they try to sell you on is like, hey, the upside is you will never lose money. So we will never make the value of your money go down, but you are not going to receive the full gains. So people hear that and it's like, oh, that's like a risk-free way for me to invest money in the stock market. But in reality, you are paying for a product that you probably don't need, because if we think about the purpose of life insurance, the purpose of life insurance is to essentially cover your dependents with income if your income was suddenly lost because of premature death, right? Most of us do not have dependents for our whole life. So already we're paying more money for a product that we don't really need. But the reason we're being sold on it is because of these cash value accounts. They're like, well, what if you had a life insurance policy where you could actually take out money from it while you're still alive? That's their pitch to you. And think about this pitch. This is how it often gets sold to you. And I'll try not to get too much off of a side tangent. This is how these products get sold to you, okay? I want you to erase everything that I just told you. If I came to you and I said, hey, I know you're scared about investing in the stock market. What if I had a way for you to invest in the stock market where you would never lose any money? You have zero risk. You'd be like, ooh, that's cool. And then not only that, you're going to have life insurance so that if you die, your family is going to get $1 million. I'm like, okay, cool. Sign me up. And then anything that you pay for into the policy, there's a certain amount that will go into a cash value. And the savings account, which is going to grow according to the stock market, totally risk-free. You can take that money out tax-free at any time. Pretty cool, huh? Like you're going to hear that and be like, oh, you mean I can have tax-free withdrawals? I can have an extra savings account and my money is going to grow, but I'm never going to lose any money? That sounds pretty good, right? Like that's such a good pitch. But obviously it's not, because you're going to be capped on what you can earn and only a small amount is going into that cash value. So it's like if you're banking it off of this cash value, well, you probably could have just been investing in the stock market on your own, had significantly better results because you wouldn't have been paying for a product you didn't need. So unless you need permanent life insurance, you need life insurance for your whole life, or you are a millionaire where your estate is so large that you have more than $11 million in liquid assets that you want to pass on tax-free. That's when a life insurance policy may make sense for a wealth preservation tool. But because of the fees, because of the cost of the product, and because of the caps on what you could earn, you are not using these tools as wealth accumulation tools. They are at best wealth preservation tools, but they are sold as if they are wealth accumulation tools. Okay. No one is getting rich off of life insurance products. Are they preserving some funds? Are the wealthy using these to preserve some money? Yes. But unless you have a net worth of over $11 million, this is like territory we don't really need to be in most of the time. So anyway, going back to indexed universal life, I had to throw that in there because I do think that pitch is so enticing. But you can choose to leave your money inside of a regular universal life. You get the choice of indexed or just a standard universal. Again, a universal life insurance policy is going to give you a fixed amount inside of that cash value, whereas an index is going to be in line with whatever index they're matching it up against. Now, there's unfortunately more ways that you may be earning less interest rate than what they promised you inside of that cash value, because that policy can restrict the interest you earn based off of something called a participation rate. So a participation rate will dictate whether the cash value you tied to the market can fully participate in the gains of the index. If that sounds confusing, it's because it is, because they're trying to make it confusing. So essentially, the idea is that if you have a participation rate below 100%, and whatever the participation rate is going to be different depending on the policy, but if it's lower than 100%, you're going to have lower interest that you can earn. So for example, let's say that the index that it's mirroring is a 12% gain. And then let's say the market cap that the insurance product is like, well, we won't give you more than this amount is 10%. But if your participation rate is only 70%, then you're not going to earn all 10%. You're only going to earn that 7% interest rate. So this is a concept a lot of people don't understand about their life insurance policies, but it's like just another way for the insurance company to make more money off of you and to give you less. So again, these are really shady products, more shady the way that they are sold. Now, going back to the cash value of an IUL, IULs often need close monitoring, which if you know me, I'm all about lazy investing. So this isn't I'm not a big fan of that. But it's because if your cash value is experiencing a low return, then you may need to pay more into the IUL in order to prevent the policy from lapsing. So you've got to funnel more money into something that's not sticking with the gains that you were supposed to be making, that they told you were going to be making, because you don't want to lose your life insurance, like if you needed life insurance. The IUL coverage fees may also increase over time, which could eat away at your cash value and again, risk a lapse in the policy. So two other types that I want to discuss is variable life and variable universal life. So if you thought indexed universal life was confusing, these are slightly more confusing. So buckle up. Variable life insurance policies allow you to put your cash value into investments of your own choosing. So that can often be riskier, especially if we don't understand how to invest in the stock market. The premiums are usually fixed. However, unlike index universal life, usually with variable life insurance policies, you do get the full amount of the return. So if you put it into the S&P 500 and the S&P 500 returns 30%, then you get that full amount usually. Now, variable universal life insurance policies are super complex. So again, they're known as VULs, but the cash value is dependent on the investments you choose, but you can adjust your premiums and your death benefits just like you could with the universal life insurance policies that we're talking about before, whether the indexed or just a regular universal life. So if your investment choices are not planning out the way that you hoped, you could end up owing money or losing coverage, because remember, the cash value of your insurance policy is going to help fund your insurance policy and keep it open. So if the cash value is declining and you're not making money, you may have to funnel more money into it in order to keep the policy active. Now, with both a variable life insurance policy and a variable universal life insurance policy, you get to decide what you invest in, which may be good, may be bad. Most of the time, it's probably not very good. But there is no guaranteed death benefit because it all depends on you making sure that the policy stays active, that you are paying enough into the policy in order for that death benefit to stay active. So you can pay a fee to get a rider that you will get that guaranteed death benefit. But of course, there's more fees. But again, they're banking on you understanding how the stock market works, and you may end up owing more money or having to pay more into it. So I'm trying to be unbiased and really just give you the information here. So when I think about what somebody may view as the pros of these permanent life insurance policy is that, hey, if you happen to need life insurance for your whole life, you do have that option with these. You could have lifelong coverage. And for most of them, other than the variable universal life and the variable life insurance policy, you will have guaranteed death benefits. Again, though, on the flip side, I want you to ask yourself, do I actually need life insurance for my whole life? Most of us don't, because think about it. As your children age, hopefully they become independent, right? So we don't need to pass on, a life insurance policy to cover cover our income that they were relying on. The other thing is, hopefully during that time in which our children were aging and we're getting closer to retirement, we're accumulating our own assets. Those assets can go into your estate that you can then pass on to your children in order for them to start building their own generational wealth. So that's kind of where it's like, do you even need life insurance for your whole life? For most people, the answer is no. The other pro I can understand is this idea of being able to build a cash value. I don't really think that's actually a pro because, again, you're paying for a product you don't need, and you could have just been saving that money instead. And we're talking hundreds of dollars, if not in some cases over $1,000. But you can borrow that money from the cash value tax-free. You can withdraw it tax-free. That's about it. Like, sure, you get some tax deferred growth and tax-free death benefits, but beyond those things, I really don't see the benefit of permanent life insurance unless you are incredibly wealthy or have special circumstances, like where maybe you have a dependent for your whole life and you do need to make sure that, you're able to pass on $1 million to them when you die. Now, the cons of permanent life insurance, it really boils down to three things. One, you're paying higher premiums for a product you may not need. Number two, your cash value is probably not going to grow at the rate that you expected it to because they're often oversold, and there's always so many different things that are going to eat away at that cash value. And of course, they're super complex policies. So it's hard to fully understand what you're getting yourself into, even if you are an expert, because often the people who are selling these products don't fully understand the products themselves. And they certainly don't understand the difference between these products and actual retirement products like a Roth IRA or a 401k. So it can unfortunately be very much the blind leading the blind with these. These policies also have high surrender fees and charges. So you kind of feel stuck in them when you get into them. But at the end of the day, most of the time, unless you're so deep into it that you do have a significant cash value, most of the time people are better off canceling the products and rather than staying with them when they understand that it's no longer the right product for them. So hopefully that gives you a little bit more of an idea of why I'm not a fan of these products, because when we think about the alternative is investing in our retirement accounts, investing in taxable brokerages, building our wealth in ways that we fully control, that we get to decide what we invest in. We get to decide what type of accounts so that we can determine what kind of access we want. That's all in our hands rather than putting it in the hands of a life insurance company. So that's kind of my whole spiel. I hope it wasn't super biased because, yeah, I do find these products really frustrating, mostly just because of the misinformation that they spread and the cutthroatness of the insurance salesmen who one of their strategies is to convince people that things like 401ks and Roth IRAs are scams, and they definitely aren't. So I hope that helped. And I think I did that without going on too much of a rant. So I hope that helps, and let me know what questions you guys have. And I'll see y'all next week. All right. Bye-bye. Thank you so much for listening to the Money Bear podcast. If you've made it this far, do us a favor, take 2 seconds, rate, review, and subscribe. It seriously means the world to me. And if you just take a sec to do that, I will appreciate you endlessly. And if you do, let me know on Instagram and I'll thank you personally. So, got that. And of course, since we were talking about anything financial on this show, please note that nothing on this show is intended as financial advice. I don't know you, unfortunately, and because of that, I cannot tell you what to do with your money. You got to work with a financial professional who knows your situation, who is preferably a fiduciary, and keep in mind that everything that we talk about on this podcast is for education and entertainment purposes only. It's all my opinion. So, there's that. If you want to see our full terms and conditions, head on over to the show notes. And while you're there, we've got free resources for you to get started on your money journey down in the show notes as well, including a free guide to help you with your budgeting templates and budgeting tutorials and investing 101, understanding the different accounts that are out there. All that good stuff is inside of my free guide, which is also available at thelazyinvestorscourse.com/guide. And if you're ready to take our relationship to the next level, I am also hosting a monthly investing class. And that investing class, you can find the times we're offering it this month at thelazyinvestorscourse.com/webinar. That link is in the show notes as well. And that's where you have the chance to meet me live and ask those money questions live. It's a good time. We've had over 20,000 people as of recording this join or register. And yeah, it's always nice to meet you guys. So I hope to see you there. Again, all that is available down in the show notes. So thank you again for coming and listening. I appreciate you, and I'll see you next week.